Making smart business decisions with free cash flow and investment tools. Introduction. In today's session, we're exploring how businesses can manage free cash flow, FCF, effectively and use business-friendly investment tools across different scenarios. Understanding FCF helps businesses grow sustainably and respond strategically to opportunities and risks. Understanding free cash flow, FCF. Free cash flow is the cash generated after deducting capital expenditures from operating cash flow. It reflects how much money a business can use freely for growth, paying debt, or distributing profits. Formula: FCF equals operating cash flow, capital expenditures. In Kenya, for instance, a manufacturing firm in Thika might use FCF to expand machinery or open a second facility. Internationally, Apple uses billions in FCF for stock buybacks and product innovation. Why managing FCF matters. Financial flexibility: FCF lets a company act on opportunities quickly. Investor confidence: strong FCF attracts investors and lenders. Sustainability: businesses can survive downturns without relying on loans. Kenyan example: a supermarket chain like Naivas can use FCF to open new branches instead of borrowing. Practical ways to manage FCF. Increase operating cash, boost sales, reduce waste, and improve efficiency. Control CapEx, invest only in projects with high returns. Preserve reserves, always set aside cash for emergencies. Pay down debt, free up future cash by reducing high-interest obligations. Investment tools businesses can use. Stocks: ownership in companies, high return, high risk. Bonds: fixed interest income, lower risk. Mutual funds: professionally managed pooled investments. ETFs: flexible, liquid, and diversified. Real estate: long-term appreciation and rental income. CDs: low-risk savings with fixed returns. Kenyan context. Sacco fixed deposits can be a low-risk alternative to CDs. Selecting the right investment tool. Match the tool with business goals and risk appetite. Risk tolerance: is the business ready for ups and downs? Time horizon: how long can the funds be tied up? Liquidity needs: are quick funds needed for operations? Expected returns: what level of gain is realistic? Scenario: high FCF in a growing business. A fast-growing business in Nairobi sees consistent FCF and wants to reinvest. Recommended actions: expand operations, buy more equipment, increase marketing. Invest in high-return assets like stocks and mutual funds. Acquire real estate, for example, invest in a Nairobi commercial space. Diversify, balance risk and reward with a mix of tools. Scenario: mature business with stable FCF. A Kisumu-based logistics firm with steady earnings and low growth needs safer investment. Recommended actions: go for bonds or CDs for predictable returns. Keep cash reserves for flexibility. Pay off long-standing debts to reduce interest. International parallel. Utility firms in the US often take this approach to preserve capital and stability. Scenario: volatile cash flow business. A flour export company in Naivasha sees cash fluctuate with seasons. Recommended actions: build larger cash reserves to survive lean periods. Use money market accounts for liquidity. Consider business interruption insurance to protect revenue during disruptions. Scenario: high risk, high reward business. A tech startup in Nairobi's iHub aims for aggressive growth but faces market uncertainty. Recommended actions: reinvest in product development and customer acquisition. Explore venture capital and emerging markets. Balance with diverse, high-return assets like ETFs. Example: globally, Tesla reinvested heavily in R&D and infrastructure during early growth. Scenario: business in stabilization mode. A tourism business in Diani is recovering from a downturn. Recommended actions. Use FCF to streamline operations and cut inefficiencies. Prioritize debt repayment to improve cash flow. Focus on safe investment tools like bonds or CDs to avoid added risk. Managing investment risk. Diversify, never rely on one asset class. Work with professionals, get insights from qualified advisors. Adjust regularly, monitor investments and tweak strategy as conditions change. Example: a Nairobi firm diversified across local T-bills, REITs, and unit trusts for stability. Balancing FCF and investment goals. Understand the difference between short-term and long-term goals. Maintain emergency funds to handle surprise costs. Seek risk-adjusted returns that match your business profile. For example, an SME in Eldoret might allocate 40% to short-term needs, 30% to debt, and 30% to long-term growth. Mistakes to avoid. Over-investing in high-risk ventures can drain vital funds. Ignoring liquidity needs leads to cash shortages. Underestimating future operating costs disrupts planning. Case study, real-world application. A mid-sized Kenyan agribusiness earns KES 140 million FCF annually. Allocation. KES 56 million in local and global bonds/stocks. KES 28 million in liquid savings for short-term use. KES 42 million to reduce bank debt. KES 14 million in land acquisition for future value. Summary of key lessons. Managing FCF strategically ensures financial strength and adaptability. Investment tools must align with your business goals and risk level. Different situations need tailored strategies. Always balance growth opportunities with financial stability. Free cash flow is your business's engine room. Invest wisely, manage risks, and tailor every strategy to your reality. Whether you're running a startup in Nairobi, a retail chain in Mombasa, or a multinational abroad, smart cash management drives success. Thanks for watching. Now go and make your business money work smarter.